So the emphasis today is going to be very, very much on how the golden anchor works. Because if you get the golden anchor right, then you should make very good money, and you've got a much higher probability score rate in your trading if you really master the golden anchor. And it's something I've not seen taught elsewhere at all. In all the years I've been trading and teaching, I've not seen anybody teach this golden anchor, and it's actually really, really simple, which is the beauty of it. Let me just grab a drink, hang on. But the actual open setup is fantastic, and again, you just have to concentrate on it and get that right, and then you really are going to be a good Scalepr School graduate, and you should be tucking away profits in your account. Right, let's get going. So trade daily, earn daily. So I do hold some positions overnight in the futures, not very often because of the leverage I use. So it has to be a choice setup for me to get going. Like I said, ask questions throughout, and I'll come back to them if I don't answer them immediately. By the way, I hope you can all see this clearly and you can hear me clearly. Okay, so I have to go through the disclaimer. Trading carries risk. Risk management is crucial whatever you do in trading. And way too many people do not use trade management skills adequately enough. And that's why it can chip away at your account and damage you psychologically as well. So you really have to pick up on those trade management skills. Any trades you see in my trading room, while I'm trading, and any trades I talk about in the chat room are for educational purposes only. If you do not like the trade and suggestion I'm taking, do not take it. It's got to be off your own back, your own decision. End of. Okay, all of this material is protected, very well protected, including the trademark. So the reason why we're here is because markets move sideways 80% of the time, and we're going to exploit that. That's a bonus for us day traders, not a hindrance. Retail brokers make their own markets. I trade the futures and the retail brokers account as well, so I will link you between the two. What I see in the actual heart of the futures market is much more relevant than what you see in a retail broker's account. So that's where, by being in the room, that's where you can get another edge in this market. Algorithms dominate the markets, and the days when you get healthy pullbacks are gone. The algorithms tend to overreact because they're machines. Once one machine triggers, another algorithm triggers, and the whole thing avalanches, and you get extremes rather than traditional pullbacks. So we'll talk about that as well. Most traders look at small time frames. That's nothing wrong with that, all in all, as long as you know exactly what you're doing and what you're looking for. Otherwise, the reason why I put that as a point is because small time frames can be very confusing and throw a number of signals which can get very confusing and very frustrating. This system is not perfect. I'm not suggesting for 1 minute that it's perfect, but it's got a very high percentage of success. So that's what you need to bear in mind as well. Don't expect every single trade to work. That's just not going to happen, but expect to make a profit. Now, what we also do in Scalepr School is once we've got an initial move, we look for a runner, an intraday runner, through the pullback. So we'll go through that as well. So it's, what should you get out of being in the program and in the trading room? You should get the best and simplest way to compete. And the key word is mechanical. The idea of the concept of my trading which you are going to see in the live trading room, is to be mechanical, do the same thing every day and expect the same results. Simple as that. So we're going to look at how the open range works, and we're going to look at very specifics to do with the entry system. Like I said, the golden anchor is called the golden anchor for a very good reason. It really can provide bigger profits, more than just 25 pip scalp. Intraday reversals, that can work very, very well. That's where you generally get much bigger ranges, more opportunity for bigger runs. They don't come along very often, but you generally get one a week. On average, you get one a week. Gap strategies, I think the relationship of the market and the open to the gap is crucial. I will be going over that. Data setups. I will be opening the room for non-farm payroll and US rate decisions as well. So the room opens, just while I'm on the subject of opening times, the room opens for the US only from 2:25 to roughly 3:15, 3:30. So about 50 to 70 or 80 minutes. It varies. Casa it can be 15, 20. If I've made my profit and I've decided where I'm going to take a second trade, I will relay that and then close the room. And if I am going to open extra, then I'll let you know. And the Wednesday night sessions, I think, are a good opportunity to come along and join in and ask questions and so on. And of course, then you get the weekend video, and I quite often post charts and videos through the week. I've already put you in the Telegram rooms. There's two rooms. One where I just give alerts only, and the other is where members can chat and call trades, etc. So we're looking for the trend of the session, not the day. We can be counter trend to the overall trend at times, and we'll go over that. We want to measure how the open works, and then we want to get the best reload. So this is the fundamental system of Scalepr School. So we are measuring the high and the low of the session. Hold on one moment, I've got somebody trying to log in. Bear with me. So how does this work? Let's look. We're looking at the high and the low of the first 5 minutes. It's not the open and the close, it's the high of the low in the first 5 minutes. That's crucial. Doesn't matter what color the bar is, it can have a big influence, but overall it's the way in which the market reacts within this range. Now, if we then trigger, ordinarily we're looking for a trigger of the high of the low to tell us where the market wants to go. And we'll talk about days where you can occasionally get a couple of triggers either way. I think it was Thursday we were triggering on the Dow a couple of times on the downside, 2 or 3 times on the upside, but the golden anchor kept you in it. The golden anchor kept you on the right side of the trade, and I'll talk about a couple other things that you can do to try and compensate for that as well. But overall, if we trigger one side of the range, then we look for the midpoint on average. This is the most common entry. So if you come into a market like this, there's your range. We might trigger long, fall back, which is quite common, enter at the midline. You might dip under the midline. You might not even get to the midline, but hopefully then it will come, pull back, and then run it on a good day. And of course, equally, that's a long version. If we get a short version, we might trigger short, come back to the midline, and then drift lower. Sometimes this can take 5, 10, 15 minutes. Sometimes it can take 1 or 2 hours. If it could chop around and so on. But this, if you concentrate on it and you've measured your golden anchor up, then you should be able to get the right side of that and get your money. Okay, let's look at some examples. I'm going to be doing some simulated trading as well. This is the DAX. The DAX is less reliable than the Dow. It's become, because it hasn't got the volume, it hasn't got the momentum and the volatility. It works, it's fine. I'll show you a couple of if you are going to trade the DAX, I will show you an extra couple of tips to try and increase the probability of your trade if you are going to trade the DAX. I do call the DAX at 9 and 10:30. If there are setups, I'll call them at 9 AM UK time and 10:30 UK time. So what have we got here? We've got a situation where that's the open bar. We do actually, we just trigger short and we just trigger long, but it's very convincing. It's a very strong close right into the ceiling of the open range. So this is a situation where you just take a break. If it's a very strong signal and what I call a signal bar, then it's worth just taking the entry at the break and the stop under the low. Now notice here that this dotted line is the previous day's close. So if you are, that stacks the odds well and truly in your favor. That really adds, and I'll show you some examples this week in the last couple of days where this has happened and it's made a big impact on the trade and your entry. So if you are trading the right side of the gap and you have a strong signal bar, that's a couple of extra boxes to tick for taking the break. Now this, I know you can't see the range, but this is probably, the DAX only tends to be about 25 pip range on average. So that's a 25 pip stop with 2 ticks, so the chances of you getting 25 pips plus is high. I suspect this is at least 75 pips. That's at least 75 pips. So this particular trade was 3-to-1 risk-reward ratio. And you can see it's all over by about 9:15, 9:20. Excuse me. Okay, so let's clear that. Let me just clear my throat, sorry. Right, next slide. Another one, the gap is right down here. What I would say is you've got, this is the Dow. What happens in the pre-open is crucial. You can see on this open range we had don't know why my throat's so bad this morning. Okay, that's my throat's clearer now, so let's go. So we had a couple of ways the upside in the euros. This is why I like the Dow so much more, because you've got time as Europeans to sit here and prepare and just mark up your anchor chart and really start to think about where you might want to do this. You can see that's the open range. That's a signal bar again, and then it runs. I always use the cash close, not the futures close. I always use the cash close. I think what the cash market does is more relevant than the. I'll come on to that. Here's a good example. This is the DAX. It's not accurately drawn. I apologise, for some reason this is not accurately drawn. That's the open bar. We go right to the low on the next bar, and then we get an immediate close above. Now the one thing I don't do is I don't chase the market. So I do not want to get in up here. What I do want to get in is the open range high. And then I need to stop on the other side of the range. So within 30 minutes of the market opening, and 30 minutes after the open is a good time to wait for a trade anyway, in both the Dow and the DAX. Just gives you a bit more scope, particularly the Dow. The Dow really sometimes pauses until, often pauses until 11 o'clock, 3 o'clock after a 2:30 open. So you get, this looks like about a 260 is the entry, and you can see actually if you hold on, it actually runs to 400. Now, if you get a midpoint entry, you tend to get, as here, you tend to get a 25-30 pip push, and then you get the pullback. So if this had been a midpoint entry, we would have got in here, taken 30 pips, 25 pips off, and then reloaded on this pullback. Now I'm actually moving on into another setup here. It's the green bar, that's the opening bar. It's very, very rare. I'm very particular about how I draw my open range up, and for some reason I've been sloppy on this one. But that green bar is the open bar. I can see it coming out from this 8 o'clock point. It doesn't matter. In this particular example, it doesn't matter that much. You can see actually, if I draw that accurately, you can see that low here on that bar would have been right on the ceiling of that bar. Pauses for 10 minutes and then pretty much runs until 10 o'clock. 10:30 tends to be the reversal time in the DAX. 10:30 is something, I don't know what it is about 10:30, but once you get to 10:30, you tend to get the market either profit taking or reversing. Okay, let me run through this again. Let me go right back to the beginning. This bar is the open bar. So this range should have been slightly lower. That should have been slightly higher to match that bar. It's very annoying. I must take this slide out. The trigger bar was this bar here, this big green bar. That was the trigger bar because it broke this. So bar number one, the opening bar, trigger bar, entry. Does that make sense? So that red bar is irrelevant. It's irrelevant because it is relevant. It's actually triggered the long. This did not trigger short. It did not breach the low. So you could argue that the midpoint was the entry in reflection. That midpoint could have been your entry, but it's only a few pips above the actual pullback zone. Did you get that? Is that clear? No. Okay, we'll run through it one more time, then there's plenty of other slides. So we'll go through this again. That is the bar, that's the first bar, that's the opening bar. It does not break the downside, so it does not trigger short. This bar closes above the range, so that is the trigger for longs. So you don't chase the market, you do not get in high, you wait for it to return to the range. So the entry is here. This level is your entry level. And your stop is here. We could have, I made a mistake when I first described it because I forgot that we do actually trigger. The second bar does actually trigger. You are correct. We do trigger long on the second bar. We hold the low, but we do break the high. So it would be, had I been in the room, I would have been looking to enter here. However, if you miss the entry, or you decide not to take it for whatever reason, you get 15 minutes later, you get a chance to enter on the high of the range. Okay, so there was 2 entries in this. 2 entries. You could have taken the mid-range, the midpoint. We called it MP for midpoint. Or you could have taken the open trading range high. The midpoint probably only gets you in about 10 pips lower. That's all. But it's nearly a 150 pip run. It's 150 pips on this day, on that session. So it's a good day. Right, let's move on, and this will become, right, that's a good long example. Here's a good short example. Now this is a good, right, okay. This high hit an anchor chart's hotspot. So when we go over the anchor chart, you'll be able to see why that high was significant. So this is the opening bar. Now we actually trigger short, but we get 3 strong moves. So we could, in theory, we should have been taking that midpoint and we'd get stopped out. So this is potentially a stop out situation. There's the gap. So the shorts were trading in the right direction of the gap. However, the anchor chart resistance, there was a case for waiting until an anchor chart resistance level. So if you could either get, if you did take that, you've got stopped out. If you did take that anchor chart, you're actually in it for 3,300. It actually goes for 350 pips to the downside. 350 pips. So 10:30 is reversal time. So 11:30 in Europe is reversal time. You could set an alert on this open range high. So we drop, trigger short. You at entry point at 10 o'clock. You may not be at your screens at 10 o'clock. If you leave your computer on and put an alert on, then you can catch that. So you get a drop, then you get 10:30, 11 o'clock UK time, you get another alert. And then it breaks. If you didn't take that, you get the chance to take a break here. This is a very small, this is only a 25 pip range, I think, 25, 30 pip range. So if you get a chance to short there, because we trigger short here. So you get entry 1, entry 2, depending on what type, if you're at your screens, entry 3. You could, of course, just put an order in the book. You could put an order to sell at that point with a stop above the resistance. So there's 3 opportunities over, so it triggers at 9 o'clock, triggers at 10 o'clock, triggers at 10:30, and it also triggers again at 11. So there's 4 opportunities to short that. It's rare to get such a push higher on a short day. It's rare. Yes. The gap is a big, I do a whole section on the gap. The gap is a big magnet. It's a big, markets do generally like, we're talking about the gap's a whole nother section, so I won't go into any more detail there at the moment. I'll go over the gaps again, but before we go on from this slide, note how that trade closes under the gap and then it comes back to the gap. So just as the open range is a magnet for pullbacks, so the gap, once it breaks the gap is a magnet for pullbacks. So maybe you didn't trade that. You could still trade at European lunchtime, because if that's your confirmation that the gap is breached, and there's your pullback. And even this distance here, this is the best trade. This is the best distance. So this is still over, this is 200 pips plus. But you might have got stopped out here, not traded this, and still made 200 pips by selling the gap fill. Sorry, the gap retest. So you might have got minus 25 up here, but you still end up with 200 here. So even on a stop out, lost my. Even on a stop out, in this situation, you still end up with plus 175. Okay, let's go through another slide. Let's keep going. So yeah, this is where you actually get a signal. You actually get a sell signal on the 5-minute chart. So you get a wave of selling. So you actually trigger long here, but the trigger is a sell signal. Well, we do have a fixed target. We do have a fixed target of 25 pips for the first move, for the first break. And then we reload. So I'm moving ahead a few slides here. In this particular occasion, it goes back to the midpoint. But the deeper the first break, the more likely the open range low is the place to enter, what we call a fade. The deeper the break. I'll go over this as we get into more detail. I don't use trailing stops. If I'm in a trade, I don't use trailing stops. I keep my stop the other side of the range, and I use the golden anchor chart for targets. So stick to what, let's just stick to these charts at the moment, and then I'll come through targets and so on, and re-entries as we go through the charts. This is a choppy day. So this system is not perfect. This is very rare. Now these tend to happen on Fed days or ECB days. There's the gap. So we breach the gap. This is not drawn as well either. That appears to be the open range bar. So upside, downside, upside. Well, this is absolutely terrible. I can't remember. We haven't had a day as bad as this for a very, very long time. This was a really, really terrible day. But like I said, you can anticipate these. This is why I do not give out alerts or open the room on Fed days or ECB. What I do is I wait until these announcements are out of the way, and then I trade them. I have a data move, which I'll talk to you about in a minute. Okay. As it happens, the gaps play quite an important part here. If you really wanted to trade it, you could have shorted. So it sells, goes back to the gap, sells, sells. So there are two trades here, but these are in periods that I don't trade. I'm not interested in trades in this time of the day. You do get reversals at 10:30, so that's worth watching. So that 10:30 short, that's my if I'm going to trade the DAX, that's the time I'm going to trade it. 10:30, 11:30 your time. I take it you're based in Sweden. Yeah, you're based in Sweden, aren't you? Yeah. Well, 11:30 is the time for you to watch. For moves, you know, if this is happening, if you're getting retest, if it's short and you get a retest of the range at 11:30 your time, then that's a good time to potentially re-enter. Right, but overall, I trade the DAX less and less. I use the golden anchor more and more for the DAX because it's just not volatile enough. I like very volatile markets. So this is the Dow on a Fed day. So it actually pops up to the gap at about just after 3 o'clock. So just after 4 o'clock your time is a very, very good time to trade the Dow. So it sells, triggers long, but hits the gap and comes on a bit. This is a Fed day. This is very common on a Fed day. Triggers short, triggers long, triggers short, triggers long. And then you get the Fed announcement here, and it's still messing around. Right, let's move on. Which is the opening bar? I think it's must be this one. So triggers short, immediately triggers long, back in the range, fills the gap. It's just all over the place. These are tend to be very bad days to trade on average. Right, so this is if you get a very big range, particularly the Dow, this is an 80 pip range. So you don't want to scalp on 80 pip stops. There's the open bar. Triggers short. Comes back to the midpoint. Triggers short again, just very, very narrowly. And then triggers long. But this is sloppy, isn't it? It's not, there's no conviction in this trading. There's no real direction. Heavy sell, slowly grinds higher, dips lower, slowly grinds higher, dips. This is not a healthy market. Now the anchor chart should keep you in this. So the floor is 26,000. Markets love big numbers. They are a big magnet. So I would not short just above 26,000 because these big numbers are so important to the market. I would not short if this was 26. My pen keeps going. If this was 26,050, I would not short this. It's too close to a big number. So most of the market was buying 26,000. And it eventually does 100 pips to 26,100. And there's the gap anyway. So I would have been buying 26,000 and targeting the gap fill because it's a big number. Simple as that. Right, I'm going to move on a bit quicker because I'm dragging my feet a bit here. Right, sloppy day, horrible day. The gap plays a big part in it. That's fine. Right, now this is the best scalper school entry. This is the very best scalp school entry. So you get a push up here. So if you miss it, I've had graduates, scalper school graduates, who don't take breaks. They only take this is called a fade. So it's jargon. It's jargon for pullback. So there's the momentum. Now, like I said, the bigger the break above the gap, the higher the probability it will run. So the bigger the gap. So if this only pulls up for, let's say, 35 pips, 30 to 35 pips, the chances are that will probably go back to the midpoint. If it comes up, so if it's less than 30 pips, aim for the midpoint. If it's at least 40, 50 pips or more, aim for the high of the range. Now, sometimes this could be 10, 15 minutes. Sometimes it could be 30 to 60 minutes or more. It varies. I'll show you some examples. Right, this is open bar. breaks, midpoint pullback. This is about 550, and it goes to about 650, 620, 630 maybe. So this midpoint entry gives you at least 75 to 100 pips. It's not a particularly high move, so aiming for the midpoint entry is better. Had it have been up here, I would have targeted the high of the range. It's not that high, so target the midpoint. Okay, now the reason why these trades are so good is because they're counterintuitive. They're counterintuitive because you know, if a market, the less experienced, the novices will think, okay, well, if that's gone up that high and it's dropping, that's probably going to be a short. A lot of people would think that's just, some people would think that's just going to short. But this pullback is really, really important. Sometimes, you know, like I said, if it's very high, it can seem like when it comes back to the high of the range, it can seem like a terrible entry point, but it's normally very, very effective. For a midpoint, I normally it's called midpoint because it's middle of the point, so 50%. I normally look for 50% in a midpoint entry setup. So this slide before, that was 50%, and that's typically what I find works. It can vary. It could be just a little dip underneath. It could be a full 100%. But I normally aim for, if I aim for 50% and do not get in the trade, then in a situation like this, then I would take the high of the range. So if I'm not filled at the midpoint, I would raise my entry to the high of the range. If I'm not filled up, but I would not chase the market. The key thing is I would not chase the market. I would not start getting in up here or here. No way. That's too high. I would want the pullback. I'm an Elliott wave fan. So here you've got 1, 2, 3, 4, 5, 1, 2, 3. This is a full Elliott wave move. You can scale Elliott wave moves to small time frames. They are designed for big time frames, particularly weekly charts, but they do work on small time frames intraday as well. Right, okay. Right, okay, here's a good one. This is a very good entry. It looks good, doesn't it? This, you know, prior to the US Open, this was moving up very well. This has moved up this is 400 pips. So less experienced guys will be looking to buy pullbacks. But it breaks, it doesn't pull back till about 3:30 my time, 4:30 your time. So it takes at least 60 minutes to pull back. And note, so that's the, I think that's the opening bar. There's the break, and there's the pullback. So that is a fantastic entry. And you've got the gap down here. So if you short, if you sell, you're trading to the gap. And the Americans like, forget what happens in Europe. This is an American market. If the Europeans have had this price down here at 400, you can bet the Americans, you know, if you were American and you would want your market to come back to a price that the Europeans have seen. And notice that bar there is right on the gap. So that's a perfect entry for a short and a perfect target for a gap fill. And that gets you, that's probably, that's almost, I reckon that's nearly 350 pips. This is why this system is so good. When it works efficiently, it can give extremely good moves. So my rule is I take every fade, or nearly every fade. Particularly, I would definitely take it if it matches my anchor, my golden anchor. There are occasions where the volume is very high and it doesn't match my golden anchor, where I might consider not taking it. But most pullbacks, most fades, I would take and sit in. Okay, so all that, this is, here we are, this is an example of a very big, there's the open bar. This is a pretty good, you get 20 minutes of buying that takes you from about 425 to about 550, 540. This is a good example of where, so that's a decent move. That's a good 125 pips there. But you do not chase the market. I do not chase the market. I'll come on to that later on. I'll answer that question later on about volume. But look at it, that is right on the high of the range. Absolutely to the pip. So that is a really good sign of a healthy setup, a healthy entry. So it goes up about 50 pips, almost retests the fade, almost goes back to the high, not quite, but it does it again. Comes right the way back, doesn't quite, so we're getting higher lows. So we're getting a little three-wave move here. And then we eventually break. So now fades, if fades are generally worth holding until the close. Most on a good fade, particularly where you've got a big move, if you do take a fade, it's quite often worth holding till the end of the day. Well, here, if you just took it off at resistance, you get most of the move. So if you had a sell order at the open high, you would get at least 125 pips, at least. Actually, so I've forgotten I've got the scale wrong. This is 20. I've got the scale wrong. This is 24,000. This is just above 24,000. This is 25,000. So I've completely got the scale wrong. This generates. This is a massive move. This open is. This open is something like 525 pips. Yeah, this open is 525 pips. So that fade was well worth taking. have to be very patient. It doesn't, it's about 3:30 to 4 o'clock UK time. So it's a big stop. That's a very big stop. But you don't have to take a big stop. You could just come midpoint or higher, just above the midpoint for a stop. But that's a very, very profitable day. That's a week's worth of trading on a very good week in 4 or 5 hours. Right. Okay. Good example of where I'll move on quicker because I'm really taking my time here. Decent move in the Euro session, comes right back to the gap and more, breaches the gap, and then does a 1, 2, 3, 4, 5 wave move. This is 25,800, and this is just as close to 25.5. So this is a big move, and the fade, you get a fade at 4 o'clock and another one at 5 o'clock, and this is the close. So 4 or 5 o'clock my time to 9 o'clock equals close to 300 pips. Let me show you a good short sample. Right, there's a good short example. This is the DAX. So we get 550, so it's 150 pips. Takes most of the day. Huge amount of selling. Oh, this is the Dow, right. So the open bar is here. Trigger short, actually, sorry, I don't know why it's so small. Trigger short goes to the midpoint. So the midpoint is a good entry point. Trade number 1, fades at 4 o'clock, trade number 2. So you get a 1, 2, 3, 4, 5. 1, 2, 3. 1, 2, 3. Anyway, midpoint entry, stop above the highs. You get that's worth, the first move is 150 pips, and the second fade, second bite of the cherry, is worth about 300 pips. You're trading away from the gap, yeah, but we'll come on to the gap in a minute, because the gap, there are very, very specific criteria for the gap, and this meets the criteria. There's gap fills and what's called gap and go. This is a gap and go setup, where if you're so far away from the gap and the market is in that particular day, it's trending so well, then it's called gap and go, where you just ignore the gap and you go with the direction of the open. Okay, volume is the, coming back to your question about volume. Volume is the day trader's fuel. Always go with the volume. In volume days, the pullback entries tend to be much, much better. The more volume, the better. And this happened this week. I'll show you some examples. There's a very aggressive entry on Wednesday this week on the Dow, where the volume played a really key part. So you've got the gap in your favor, you've got a very bullish open bar, it triggers, pulls back to the midpoint, and that goes for about at least 150 pips. Look at this is a screenshot of my futures account, which shows the volume a little bit better. This shows you why these fades are so good. There's volume into the open, big volume, very high volume bars. Breaks, if you miss it, it does not matter. It comes back right to the top of the range with volume confirmation, and this runs from 225 to nearly 400. And that's not even the close. So you should be in the trade. I would be in that trade because it's a fade, but I would sit in it because of the volume confirmation. The volume is good up here, but doesn't increase a lot because all the big institutions have got in here and they got in here and they just sat in the trade. So you don't need these volumes to keep poking up. You just need to keep getting higher closes and look for your target. And we'll talk about targets later on. Right, so let's go through, there's 3 entry types, and I've shown you examples of them all. The most common is the trigger. So you break the range and look for the midpoint. This is a good one where you literally have a pin bar buy signal on the floor or a pin bar sell signal on the ceiling. This one, now this happened on Wednesday, and I'll cover this separately. Is where you have a big open bar and with a lot of volume, and it just breaks. It can work the other way. Of course it can work the other way. So a lot of sell volume, it breaks, and there's no pullbacks. So common, midpoint, less common but still very effective signal, and then the aggressive, no pullback break. But you've got to have volume. You've got to have volume with that. Okay, let me do a screenshot of that actually, because I need to improve that slide. This slide, I think. Okay. So very quickly go through. So on the trigger bar, you normally wait for 2 or 3 bars. So which way is it triggered? Now wait for the midpoint. Stop out other side of the range. Target initially 25 pips. With a Dow, it can easily be up to 50. And then look for the reload. So if you take so it breaks high, buy the midpoint, wait for it to grab 25 pips plus, and then hope it fades. So midpoint is entry number 1. On the Dow, this can be 25, on the DAX 20 to 25, on the Dow 25 to 50. The Dow tends to move about, on average, twice the daily range to the DAX. So you could adapt that. But the golden anchor is a good way of looking for exits. So that's coming up next. Okay. So midpoint, stop under the right on here, and then look for your 25 to 50 pips, depending on whether it's the Dow or the DAX. There's the example. We've looked at lots of examples. On this particular day, you get a perfect fade, and this runs for 200 pips. Good example. Now it actually triggers short here, but I did not short this. I remember this. I did not short because the golden anchor kept me inside the trade. Breaks long at 3 o'clock, pulls back to the midpoint, gap fills at 4 o'clock, runs to 5 o'clock, and is still running into the evening. So that's worth about 300 to 400 pips. Triggers short. You got 12,000 just under here. So I would not short against 12,000. I would not short that close to 12,000. Just wouldn't do it. The third bar in the DAX, it's good to wait for 3 bars at least. 3 bars minimum. It then breaks the high. You're trading the right side of the gap. The gap's fairly close, so the chances of that breaking the gap is good. And then that goes to close to 200. Signal bar. We're looking for a dominant signal bar on the floor for a long and the ceiling short signal for a short. There's a signal bar. A signal bar is a pin bar like that with a good strong close. Aggressive entry. I'll show you a much better example of this, but on this particular day we saw the gaps up here, so it's a gap and go because the gap is very, very far away. If it's more than 70 pips, it's called a gap and go. So you ignore the gap if it's more than 70 pips. You forget about it and you go in the direction of the break. There's the support in Europe at 11 o'clock. There's the opening bar. It just breaks. There's no pullback. It just breaks. It does pull back later in the afternoon, but that's a good aggressive entry. Right, let me show you a good aggressive entry on Wednesday. I'll just stop this share for a minute because I've got and I'll come back to you in, give me half a minute. I'll just go and find right, got it here. Actually, now let me just go to the charts. Let me put the screen share back on. We'll just go to the live charts. It's easier. Right, this is the Dow. Let's go back to Wednesday. Just out of interest, this is, let's have a look at the open range for Friday. Friday was options day. I did not take a single trade on the Dow on yesterday. And we had the open bar here. We just triggered short and then we just triggered long. Sloppy day. Note the volume was very high on the sell side anyway. And so you got that's a signal bar. It's just it's above. It's not very clear. Options days are like this, choppy. But it does ultimately. You come back in the range. You get another signal bar there. So you could have entered at about 360, and then the gap fill was 300. So there was 60 pips. That's the entry. Stop. You could have gone just a 20, 25 pip stop, and so stop would be about 25 pips, and your target would have been 60 on a gap fill. So the gap's nice and close. You've got volume selling, but it takes an hour, at least an hour. Triggers short, but then immediately closes back in the range. Eventually triggers short at 4 o'clock, and it takes about 30-40 minutes to give you 60 pips. That's what right. Let's go back to Wednesday. The key aspect, a couple of key things on Wednesday. I've got this volume marker at 6,000 contracts. So we hit my 6,000 contract mark at the open. So with that kind of volume and this kind of support, I don't think it's going to show me anymore. You get it comes from, let's get my pen out of the way. So it breaks at 9:50. Yeah, it breaks at 9:50, and an hour and 25 minutes later, well, actually, an hour later, you get 120 pips. No pullback. So that's the range. There's the volume. This is an aggressive entry. And then you just look for the target. And we'll come across the target in a minute. Okay, that's a good example of aggressive entry. Right, let's go back to the slides. Does that all make sense? On the break. On the break. So if the volume's that high, you literally go in, so the market's open at 2:30, you literally go on, you literally take the break of that 5-minute bar. You wouldn't need a big stop, where you could afford to go midpoint on a it's got to have volume. So entry, E for entry, S for stop, and then we'll talk about targets later on. But it's got to have volume. In this case, I've got a marker of 6,000 contracts, and on Wednesday we hit that and more. Let me do that. Let me do a screenshot of this one as well. Okay. Talking about fades, yeah, like I said, I do have a mantra of, yeah, I must take fades. And the reason why I have this mantra is because fades are counterintuitive. If the market, particularly on the short side, obviously we haven't seen the short side for a while now, for a few months, but if you break on the short side really well, the fade on the short is very counterintuitive. It does not feel right, and the best trades don't feel right. But they are, fading. As long as this is more than 70 pips on a Dow, then the fade is very, very good. It's got to be more than 50 pips on the DAX. And the fade is great. So that's why I always, nearly always, take the fades. Done that slide before. This example doesn't quite. It's a very look how deep that bar is on the Dow. That's over 100 pips. So that's about 60% of the move, 60 or 70% pullback, but not a complete fade. And there's the gap. Now this is the DAX. Now this doesn't fade until 12 o'clock midday. Decent trigger, decent open, comes back to the midpoint, drops hard. So if you miss it, don't chase it. It breaks at 8 o'clock. Oh, that must be a 7 o'clock. Yeah, that's a 7 o'clock bar. Because it's such an aggressive bar, I've used the 7 o'clock DAX open here. Goes to the midpoint at 8 o'clock, drops hard, and then, so if you miss it, doesn't matter, set an alarm, because it comes right the way back to the fade, and then still doesn't drop that as aggressively, but still drops enough to give you a good trade. Okay. Tell you what, let's break off there. Let's break for 10 minutes. Let's come back at the top of the hour. So let's break for 12 minutes, and then we'll continue. Any questions, punch them in the chat room. And then we'll go through the next stages. And I want to spend a lot of time on the golden anchor. and then we've already talked a lot about gaps and the importance of volume. So we'll come back in 12 minutes and then we'll go through the next stages. Okay, thanks a lot. See you then. Yeah, good question. I differentiate between an ordinary day and a high volume day with that marker that you saw on my volume. You know, I set the bar at 6,000 contracts at the open. So that constitutes an aggressive entry. I haven't seen many signal bars for a while. Like I said, the midpoint is the most common entry, and on average you get one aggressive entry a week, but we should be able to tell them by that bar. Right. Didn't understand the signal. Okay, let's go back to the signal. Well, I guess this is a signal. So you got here, there's the break. So you're looking for shorts. So you got two choices. You could take short at the retest, the pullback to the range, or you could, that's a pin bar signal. That's a rejection of the range. So you could go either. So you got entry number one is the floor itself. Entry number two is the signal bar, the pin bar there. So you're looking for ideally a signal bar inside on the high of the range. Let's have a look. I'm going the wrong way, sorry. Well, that's a signal bar, but this is prior to the open. But if this bar here was the second bar, I would have shorted at that level there. But it wasn't, it was prior to the open. That's the opening bar. This is a signal bar long. That's a signal bar long, a pin bar on the floor. So I remember this now. Yeah, I was going long here. It doesn't have to be. It's normally a good signal bar will be after 3 bars. Yes, it has to be. It has to be after the 5 minute. It has to be after the open, and it has to be on the floor for longs or the ceiling for high. So this is a good signal bar entry. This is a signal bar entry. And I did take this. You get 2. 1, you get 3. You get 3 entries. 3 possible entries, but they're all off of the floor. So 3 types of entry. MP, midpoint. So trigger, midpoint, return to the midpoint, signal, and aggressive. Got to be volume. 6,000 contracts, ideally. Signal must be on the floor. Or ceiling. Okay, three types of entry. But this is the most common. This is about once a week. And this is fairly rare. Don't get, actually we had one on Friday, didn't we? Yeah, we had one yesterday. Okay, let's move on. You're going to get a check sheet anyway. So let's get back to where we were. I want to move on a little bit faster because I'm really taking my time here. I want to get to the golden anchor. Okay, so a couple of other things you can add to this. If you come into the markets with some really, this was overnight. This is in Asia. So on this particular day, the Dow moved from 27,000 down here to 20 to it's okay. It's not a massive move. It's over 300 pips. So guess what? When the Dow opened here, it dropped hard, but only because the US market wanted a slice of this action. I think this would have been better if the fibs was here and here. I've actually fibbed this big move here. I think if you fibbed that whole move, if you'd have fibbed the 320 pip move, you would have seen that being a zone area. Anyway, at 4 o'clock, so we get a big push up to 330, around about 330. Another pullback at 4 o'clock to this area here, and then it moves from 130 to 300. So it does I call it a boomerang, and it's based on the fact that if the US are not going to pay that price, if you were trading the US market and you'd missed all this, why would you want to pay that price for it to go higher? You're going to want a pullback. Where's the pullback going to be? Well, if you fib it, the most likely place is in the lower half of that range, because that's normally what the market does on pullbacks. If you are an Elliott wave fan, which I am, you would the normal specification for an Elliott wave pullback on a wave 1 is 60%. So if that's wave 1, a 60% drop is wave 2, and wave 3 has to be bigger than wave 1. And is normally the most powerful wave. So if that is an Elliott wave on a daily chart, that's going to be an Elliott wave on an overnight chart. That's probably, these fibs are drawn, these fibs should have been drawn from here to here. And that's probably 60%, that's a good 60% drop. That takes you back to the highs. Okay, right, let's move on. Right, what's going on? Oh, I know what's going on here. Okay, if you've got a big, what I'm saying to you is if you've got a big day, here's the open, 230. Aggressive move of 250 pips. Here's the close. So you get a 1, 2 wave. So this looks like a lot of selling, doesn't it? That looks as if the market's rolling over. It's not rolling over, it's pulling back. So this is counterintuitive. Buying here is counterintuitive if you are a novice. But to a normal trader like me, this is the pullback. There's the move. You get a 1, 2, 3 wave high, 1, 2, 3 wave pullback, and a 1, 2, 3 wave close. So if you missed out on this, you could just trade the close. If you missed out on it, it's an aggressive entry. It does get to 6,000 contracts. The volumes are, this is an old chart. The volumes are much higher now. But you certainly get a lot of buying into that open here. So there was big clues that this could break up. The other thing is, forget the fibs. Look what's happened. Here's the open range. Triggers long, goes back to the gap. So the midpoint's just underneath it, but the gap's in between the midpoint and the break. So I think you're more than justified by taking a gap entry. It's not that big a stop, it's not that big a range. Get your stop under here, and with all that volume, see if it can run. And it's all over by 90 minutes later, it's all over, and you've got 250 odd pips in the bank. Right, more. Yeah, this is. I talk about aggressive entries. Just a bit more detail on aggressive entries. This is a very aggressive sell. I think this was early December last year. This is a 30-minute chart here. This is a 15-minute chart, which is our golden anchor, and this is the 5-minute open range. This is the half-hour bar under an 89-day. I love the 89-day average, by the way. That's a sell signal, pin bar, on this chart on the open. These are weekly pivots. I don't use these anymore. I've just gone back to fibs. Not a lot of it. In theory, there's not a lot of difference between weekly pivots and fibs, but I've gone back to fibs. There's the at 2:15 UK time, you get a sell signal under this average, and it drops to. This is the previous day's high. This is the previous day's low. Sell signal before the open, pulls back to the average and drops back to the previous day's low. That's a good 200 plus pip move in 45 minutes. Look at the volume here on the 5-minute chart. 6,000, nearly 6,000 contracts at the open. Hesitates and then drops. And this is the, if you'd not if you're not good at Fibonacci, if you don't fully understand Fibonacci, you really need to go and do you consider yourself a good master of Fibonacci or a beginner on Fibonacci? Do you understand Fibonacci? You do, good. Right, okay, well here's the outer zone on the 5-minute chart. I fibbed that range. There's the inner zone. So it comes back to the high of the fibbers of the inner zone. So on a good drop like that, I would expect either that level or that level to short. So at 6 o'clock, we go back to 567 to the pip, 568, and then we almost go back to the day's lows. So it's a 1, 2, 3 wave move late in the day. But there's your signal for the open. That's an aggressive entry. All set up prior to the open. This is the opposite. This is a squeeze long, 15-minute chart. So this is last week. So this is Monday, Tuesday, Wednesday. This was the prior day. So we had a big 1, 2, 3, 4, 5 wave move, 1, 2, 3 wave correction. 5 and 3 is what Elliott wave is all about, if you don't know Elliott wave. So this was a key level of support. This was the key launch pad for Tuesday. We had a buy signal prior to the open, off of that support, and this was the trend line resistance. It powered through in the first 15 minutes and took off for 45 minutes. I think it was a good 250 pips, I can't remember. So that's an aggressive entry. Yeah, week 3 this year, golden anchor, GA's golden anchor, an aggressive squeeze. Pity I can't spell aggressive. Apologies. So preparation is the key. I'm not going to go into this, but you can use day trading to hedge. I'll come on to that another day, but I'm using up a lot of time here. Let's talk about the golden anchor. Let's skip the 3 wave move. So I'll do the 3 wave move very quickly, and let's go straight to the golden anchor to answer your question. This is oil. I do like oil. I trade oil about 2 or 3 times a week. This was the invents are 2:30 UK time on Wednesday normally, unless it's going to be Thursday this week because we've got Martin Luther King Day Monday. 2:30 p.m. my time at the invents. So I don't trade the invents. I stand back. I look for the direction. So that's direction at 2:30. 100% pullback and move. So 1, 2, 3. I like to get in on the end of wave 2. I look for 60 to 100%. And it normally takes at least 30 minutes, quite often an hour. Don't have to sit around watching it, just alarm it. See the gap there? So it gaps up on invents, fills the gap to the pip and runs. And that was worth about at least 80 pips. It's worth 70, I've said 70 pips. Okay, let's move on. We've plenty of time to look at the, and that goes for Fed days. On Fed days and monthly jobs, I look for the direction, wait for the pullback, enter, and then look for the run. So look for the direction, wait for the pullback, enter, and hope for the run. That's data trading. So that's oil and gas inventories, or monthly jobs, or monthly rate decision, or 6-week rate decisions. This is don't know what date, doesn't say what data it is, does it? Direction, pullback, move. Worth 300 pips. Direction, pullback, move. I think that should say NFP, non-farm payroll, US jobs, October 4. And we did a fairly shallow pullback. There's the move. It's untradeable. Unless you're an algorithm, that's untradeable. Breaches the 50%, just almost goes back to the zone. So direction, pullback, move. And it goes to the 161 extension. Pulls back to the high of the break. So you've got one entry, one target, two entry, two target. Worth a lot of pips. Worth about, with the two trades, that's worth at least 300 pips. Right, so let's just go through a few basics in summary. Keep those questions coming if you've got any. Don't chase the market. I will trade later in the session or later that day if we get good 70 pip plus break. Dow moves twice as fast as the DAX. So if you prefer a slower market, don't trade the Dow, trade the DAX. If you prefer a faster market, don't trade the DAX, trade the Dow. Yeah. And always trade whatever suits your personal style. So you could take these setups, you could take these rules and apply them to your style of trading based on your risk, your personal risk management. So you don't have to do, nobody has to do what anybody else says. If you want to change the risk management to suit your style of trading, but still use the basic rules, that's great. With the fade, I said here, paper trade this at first. Obviously, you're just new to the system. You might want to paper trade it, particularly on the fades, the pullbacks, to get used to them. They don't always work. Nothing always works in trading, but the ones that do work will far outweigh the ones that don't by a mile. Okay, if you ask questions in the room, I don't, because I'm so focused on trading, I sometimes ask them later in the day. So avoid Fed and ECB days. Wait until the data's out. Big open ranges, wait at least, be much more cautious. Wait at least 2 15-minute bars if it's a very big range. Not sure what I mean by this 0.3. That's a bit strange. I have to go over that. Low probability trading against the previous day's gap of big numbers. I've gone over that with some examples. So if I would not short just above a big 26,000 number, for example, as I explained in that chart. It's lower probability trading if the gap is, if you're trading against the gap that's so close. We'll go overall, we've gone over these slides. Be very wary about trading in the doldrums. The doldrums to me is around about 11 to 1 o'clock UK time and 5 to 7 o'clock for the US market, again UK time. Right, the golden anchor. This is really, really important. This is the crux. This is the main part of the system. So you really need to sharpen your pencil and make sure you understand this golden anchor. Okay, all it is I'm fibbing the previous day's high and low. So I'll just repeat that. I am applying the Fibonacci on a 15-minute chart to the previous day's high and low, previous 24 hours. I do like to fib the 60-minute, the 1-hour chart to the previous week's high and low, and then I fib the 4-hour chart to the last main move. Algorithms use fibs. To me, that's the code of trading. So these are 3 time frames where I use fibs 3 slightly different ways. Pull them together and they make a very important part of my trading, and I'm suggesting they make a very important big impact on your trading. Okay, 3 aspects to this. As you are familiar with fibs, this is as a only the cash let me go back. This is really, really important. Listen to me again. I'm trading the previous day's range, the previous 24-hour range, not the cash session. The only time I fib the cash session is if we've had a very big move in the 5-minute chart. Okay, you clear about that? I'm only fibbing the 5-minute chart on a cash session if the move at the open has been very big. So I'm fibbing the previous day's high and low in the futures 24-hour market. We'll go over some examples. So what this golden anchor is telling me, it's telling me if, can you not see the chart? You can see, yeah. Can you see my chart, by the way? Yeah, it's telling me to resume the share. It looked as if the share was switched off. Okay, as long as you can see my chart, that's fine. So we're looking for the golden anchor in a good strong trend. We're looking for the golden anchor to pick up the pullback area. If we break the previous day's high and low, we're potentially in a breakout situation. And if we are at an extension of the golden anchor, we have potentially got an intraday reversal. So you need to get used to those 3 aspects of it. So if you combine this, the key to this system is if the 5-minute range matches a golden anchor level, the higher the probability of the trade. So let's look at some examples. So we're looking, so on a good strong, on these blue arrows, if you've had a previous very good move, a strong move, there, then you look for a zone pullback. And equally, if you had a strong sell the previous day, you're looking to sell into a bounce into a fib area. Here's a good example. We had, so this is the previous day's high and low. So this is day one, this is the day we're trading, day two. So we had two ways of selling the previous day into 25,600, and then we open very high, not quite into the previous days, so we actually sold off here back into these levels. We just close above this outer zone and then immediately just close in it, and then we go to a 127 and a 161 extension. So if you take a trade here and it moves very aggressively, then these are the targets, and you can see it breaches the 161 extension, but in the meantime you've got a very good pip count, you've got a very good move. So I would be out here, I will be at least, I would move the stop down to capture some of the profit. I wouldn't trail it, but I'd move the stop down. That's my personal preference. If you prefer trailing stops, then that's up to you. I do trail it, but not automatically. I trail it manually to lock in profit. But that was target number one. We breached it. Well, I'm just concentrating on the anchor chart for the moment. So let's just concentrate on the anchor chart only, because there are some occasions in the live trading room where I take anchor charts and not open range charts. If, for example, well, this is a good example of a situation where we had all this selling, we get a sell signal just on the top of the zone. So that I would take that short there with a stop above that high, which is not that big a stop probably. And within 30 minutes, you actually hit the 127 extension in 30 minutes. So I'll show examples of where that you can marry the two together later on. Let's just concentrate on the anchor chart alone. But that is, you can see even in the overnight and the European session, it struggled to get up there, and then had a sell already into the European midday. So we've gone back to a resistance area. This was a key signal bar here. So all we've done here is gone back into that zone. In a way, it'd been better if I'd zoned that area to emphasize that signal bar rather than zone this area here. But anyway, so within 30 minutes, we almost touched the 127 extension. Another 30 minutes, we touched the 161, and then we bounce. Here, much later in the afternoon, you actually get an intraday reversal. So you could have traded a one and then a one wave drop, and you get confirmation here of the 127. You could have bought a 127 back to 50%. With a relatively tight stop. Okay, so it's about just using basic Fibonacci entries on the previous day. Let's this is an extension intraday reversal. These can be very, very good pips. So this is the Dow. I do trade the Dow in the European period if it's good setups. So in the European Open, 9 o'clock, or an hour after the London Open, we get a reversal off of about 350, and we go from minus 127 to plus 127 into the Open. So minus 127 plus 127. That if we get a reversal, that's fairly common from going one extreme to the other. In the US session, so this is the main US session, we do a pullback to 50%. So what do we get? We get a 1, 2, 3 wave move, and into the close, we go to the 161 extension. So this is a fantastic day. That's about 350 up to 600 on just the golden anchor chart alone. That's why I've named it the golden anchor, because it can be so effective. All right, so I'll just go to the live charts in a minute. Big sell signal, a lot of selling. Here's the US Open. Go into the zone, top of the zone. Only a minor breach in the European midday. This is a very aggressive entry. The Open is just straight down to the previous day's low. So if you miss it, you get a short signal 2-3 hours after the Open at 50% down to the zone again. That's probably worth about 100 pips there. But I admit that that's a potentially difficult day from the point of view that you get the main thrust in 15 minutes. So I admit that if you didn't take that 15-minute chart, you might have completely missed that on a 5-minute chart. Okay, so just emphasizing the importance. So we're now going to talk about a break. So we're talking about this. So these were all zone trades. Actually, that was an extension, wasn't it? That was a zone 2 extension. So zone 2 extension, extension to extension, zone to the low. Now we're going to be talking about breaks. So here's a bearish move. So this was crucial. Whatever happened to that market, this is a good move up here. So this is a day where we looked good, but this bar here, obviously, I think this is prior to the Open. Prior to the Open, we closed under this bar here, so we came back to the inner zone. This is a couple of hours after the Open, and this is not a good day. This is potentially a difficult day to trade. But the reason why you could pick this up, at least you could, Fibonacci is just about support and resistance. It's just about, it's, as you know, or may know, it's nothing more complicated than support and resistance. So if you've got a chart that's closed under the previous day's high, and you've got all this support on the previous day, the chances of that coming down there and holding here is quite high. This was a very bullish day, so there was a reasonable chance that this level could hold and push back. Well, I would have probably been targeting a push back to that high, but we closed only into that resistance area. So that's a difficult day. But now, if you've got a difficult day, this is where if you trust and rely on the anchor chart, this is where you can pick up on where you might have a difficult range-bound day, because if you are in the middle of a fib of a range, the chances are you're not going to get a clear signal until it sits on a level, on a fib level. So at this time, when you sit on a fib level, the chances of that pushing up, particularly after a bullish day like that, is quite high. So this is one of the days where the anchor chart would have got you, would have saved you this mess, and potentially taken you from that level to at least that level, and ordinarily might have taken you to up there, but it didn't. I can see as I've done this screen grab, we are close to this high. So overnight and into the next day, I suspect we got up here. It's a Monday. Mondays tend to, if you've got a bullish market, Monday's the day you normally get, Monday into Tuesday is the day you normally get a pullback. So be aware of that. That's why I don't open the room on Monday, because it can be harder to trade. Wednesday, okay, so midweek, I've had an aggressive push up here. So you get some profit taking. Quite a lot of selling. Pushes higher into this resistance. So it's just this 15-minute chart breaking down how the high and the low, the zone, and the extensions are working on that particular day is going to guide, should guide you into what you might achieve on that day. So we start to struggle here, we start to close lower, come back to the lower zone, dip underneath it, and then overnight we come back down to this support. So again, not an easy day. A price cluster up here. You hold this area into the open, push up into resistance, and then just drift lower the rest of the day. So it should, these anchor charts should help you pick up. If you are not holding, if you've not got an intraday reversal, and you've not got decent buy signals off of these levels, then chances are you're going to get a sloppy day. So I quite often just sit there and just check back at different times of the day what this anchor's doing. Does that all make sense to you? An intraday reversal, a decent intraday reversal is like this. Now, to fulfill the criteria, ideally this would be this would happen in the US time, in the US Open. The fact is, I do take these in the European session, but they're more effective. Ideally, you want this to happen in the US session. So this is an extension reversal in the early part of the session. It's got to happen in the early part of the session. That's an intraday reversal to me. Let's not had many of, not, okay, let's go back, let's find a choppy, I think the best way to look at this is, let's turn that question on its head. What is the best setup in a golden anchor chart? a rejection of the previous day's high or rejection of the previous day's low for shorts. So if the market is selling off, and ideally if it's selling off, you need a pullback into one of these areas, a sell signal on one of these three areas ideally. But if it's so weak, it's down here and closing under the previous day's low, then use the extensions as targets for a short. But the key, to answer your question directly, you can tell if it's a choppy day if you are mid-level, if you are away from one of these key levels and you're not getting a signal off a key level. So this is chop because it's in the middle of the range. This is chop because you're in the middle of the range. This is better here because you get a close above this level here. So that later in the day, when you get a higher close above this level, that's good, and it immediately returns to that level. But all these signals mid levels are chop to me. Let's pull away from these charts and look at last week. Here's Friday, for example. This is the golden anchor, so it's got the price on. So this is the range of the previous day. Overnight high, overnight low. So this is. Let's look at the prices. So that's an overnight low of 80 above the 29,000 and an overnight high of 350. So it's a very decent range. Here you can see I've zoned what happened in the euro period, or the pre-open, I should say. So prior to the cash open, we were selling. Into the open, we chopped. We closed under the range, closed above the closed under the previous day's high, above the previous day's high, under the previous day. This is what I did not trade it. It's rubbish. Or at least this golden anchor is rubbish. Closed back above, but then hit resistance, zone resistance. This is a big resistance area. That's why I zoned it. Didn't quite get back to this 290 level. Started to wind up again, rejected the it's just rubbish. It's just your options days are rubbish normally, particularly after an exhaustive week like last week. So let's have a look at what happened on Wednesday. Let's scrub all this off. Right, let's fib the Tuesday. Nice volatile day. Get rid of that. So what happened on Tuesday? On Tuesday, here's the zone. So we had a big bounce off of that area on the previous day. You can see here in the European session we popped up. There's the opening range for Tuesday. Hesitates in that open range, keeps closing higher above the 50% and eventually climbs up. So coming to this session, it's so strong, we've not touched that zone again. So this is not perfect, but if you are a pattern trader, there's the resistance, this is the support, So it's so strong it doesn't touch the areas. So it immediately closes higher. A lot of support down here. And like I said, this triggers an aggressive entry on the 5-minute chart. All this is an anchor chart, so you don't have to trade off of it. Sometimes the trades are very good from it, but you don't have to trade off an anchor chart. It's just meant to use in combination to the 5-minute range. So on this day here, we had an aggressive entry. We triggered an aggressive entry on the 5-minute chart. This anchor chart just confirms the move. That's all it does, confirms the move. Some days it gives you entries, some days it just confirms the move. It's great for targets though, because you go from this aggressive entry to the 127 extension. So that's a great target. 129, not a particularly memorable, notable number, but if you want a good target, that's a good target. You could have had a conservative target at the previous day's high at 50, but if you held out, you actually got the 127 extension. Does that make sense? So it's just there are some days when I will trade off of it, but if there are other days where I would just simply use it as a confirmation tool. Now, the days when I will trade off of it is if you get these extension levels, either as targets or entries. So if you start high up here, so if we started up here at 2:30, 3 o'clock, I will be shorting that at least into the zone, at least, if not further. If we start up there. But we started back here at key support, massive zone, huge, bounced off of that zone already on the Tuesday. So the chances of that getting back to 50 is good. And there's a reasonable chance, a good chance of that getting to the 127 extension. There was even a chance that could have gone, had we closed above 130, that could have gone to 228. But into the close, we pull back. So we get a 1, 2, 3, 4, 5 wave move. Now, something I talked to you earlier on was about 5-minute chart, fibbing a big move in a 5-minute chart. So let's scrap this. Tell you what, we'll leave this on the close. Where's the... That's the cash close. Right, let's go back to Wednesday. Right, big move. So what do? You fib it. There's the high. There's the cash open. So there's the outer zone. There's the inner zone. So into the last half an hour, the last 25 minutes, we hold that zone and we go back to the high of the outer zone for about 60, 70 pips into the close. So if you want to trade the last half hour, that's one way you could do it. Just out of interest, would you look at the last half hour, or are you not interested that late in your day? Would you trade that last half hour, or is that too late for you? Very interested. Okay, that's good to know because I do call it. So big move, decent move, a very aggressive move. 1, 2, 3, 4, 5. 5 and 3 again. Are you familiar with Elliott wave? Yes, good. There were supposed to be 5 or 6 people here, so I guess they're all relying on the recording. Right. Let's put this is an anchor chart. So let's go back. Let's look at let's look at Tuesday. Just out of interest, what chart package do you use? Not clear. Okay, well, are you referring, you're not clear about the MT4? Okay. Are you using Infinity Futures? Oh, good. I like that platform. Infinity is a very good platform. That's the US platform, isn't it? Is that the one you're talking about? Well, yeah, a very good platform. Really like it. I like the way you can set it to scale out. Well, you can set any futures ladder, can't you? But their platform's particularly good for that. Right, this is Monday, last Monday, and that's the overnight high and the low. They're perfect, absolutely perfect. Can you see what happened on Tuesday? Can you see what happened on Tuesday? In your words, what happened on Tuesday? Tuesday open bar is here. This bar here. Yeah, the starting point is there's the 50%. We did a very minor breach of the 50% at the open. We held it for the next 2 bars. Very quickly went to 127 and then went to, so this is a fantastic way to measure your exits, to put your limit exit orders on. So you got a good profit at 988, but if you held on, you got an extra 50 pips. Took a ground up there very, very slowly. But over the whole day, this is your opportunity to get in. You got the option of taking that 775 and sitting in it until you get, so it's minus 127 to plus 127 and plus 161 over the whole day. And then there, so we hold the zone into the close and then just go back into the 20-day average. This is a 20-day average. I use a 20-day average because it's the midpoint of a Bollinger Band, and algorithms love the standard deviation you get on a Bollinger Band, and they tend to respect the 20-day average because it's the mean average of a Bollinger Band, if you really want the full explanation. Okay, so In the US session, we get a 1, 2, 3 wave move. The third wave is pretty pathetic. Overall, we get 1, 2, 3, 4, 5. 1, 2, 3. Yes, 89 and 20 average are my favorite moving averages. Yes, definitely. Because I find the Americans like the 89-day average. American markets love the 89-day average. If you look at this without the fibs, it is still giving you good signals, and the 20-day average picks up the pullback at 330. But what I fib the 15-minute. I use the golden anchor every single day on every single chart. Let's look at oil. As you see from the live accounts I've been posting, I've been trading oil a lot recently. Yeah, here's how I zone the oil. Oh, this is a fantastic trade on Thursday. So oil events are Wednesday. Got a big push up after the oil events. If you don't understand Elliott wave, I would suggest you go and have a look. Look for videos on YouTube from Todd Gordon. Go on YouTube and search Todd Gordon Elliott wave. He's a master of Elliott wave. I really like he's a great trader. Really like his videos. Right, so scrap all that. This is the invent range. This is zone, so the bottom box is zone support. The top box is the invent range. Okay. What's the one point you don't understand? So decent buy signal. If you're a candle fan, that's a big engulfing bar. Low stochastics, high volume. So this day here, look at the volume here compared with here. You've got to have volume. If you're gonna, it's logical, isn't it? This is the most logical part of trading for me. You've got to have volume to move a market, surely. Market's not going to move on thin air. Okay. So when you pull back to this area and you get a buy signal, in actual fact, it's a repeat. This area here is almost a carbon copy, a complete repeat of that area there. This bar closes outside of this range, tuck back in it, hold it, and then we go for an extra run. Lovely chart, really, really lovely chart. Let's scrap all that. I'll answer that question in a minute. You mean the average daily range? Is that what you mean? So this is fibs on the invent day. That's the fibs on Wednesday. That's where we came up from the previous day. That's the zone. So the chances of that pushing up from 57.65 is good. Right, the zones, right, okay. So we go from this lower zone to a 161 extension and a bit more. So that move from 12:30 UK time goes from 57.65. Yeah, it's 100 pips. That's 100 pips in 4 hours. So it takes quite a long time to wind up there. 100 pips in 4 hours. The Dow has been much, much more volatile, much easier to trade, I have to say. And then on the Friday, I only took 20 pips out of this because it's so slow. If you look at my account, I think this is the only trade. I took a stock. I traded a stock. I got a couple £100, £200 on a 20 pip move. I bought at 58.48. I wasn't trading it. I was trading in the US live session, cash session. Just one contract. Just took it really slow. Bought at 48, sold at 68. 70 was a big problem for oil yesterday. Did a 40 pip move in the last hour. Anyway, the zones, right. Let's go over it. So that's oil fibbed on Thursday. Fibonacci is a retracement tool. It's as simple as that. It's measuring the support and resistance, in this case, of the previous day. So these zones, if it's a trend, if it's a trending market, these zones are really important. These are pullback. These zones are pullback areas. These are key levels of pullback areas in these charts. If these zones hold, so if you've got a decent move on this day, whoops, you got a really nice move on that day and it's bullish, then I would look for the inner zone or the outer zone. I would look for a price in this area to trade it back up to the previous day's high and potentially, so trade it from one of these areas here. Don't know which, you just look for buy signals. And then if it breaks the previous day's high, I'm looking for extensions. But on a day like this, I would look for a zone entry. One of these three areas is going to be my entry. You can see why I took it off at 70. I think this is 70 here. So I took it from here. I just grabbed 20 pips from there. That's all I did. From a few slides back. A few slides, right. Okay, let's go to the slides. I've not had oil on these slides. These are only Dow. I've only been showing you Dow on the slides, not oil. Oh, the oil charts, okay. What is that now I've looked, now I've talked to you about Thursday in relation to Friday. Does that help? Does that clarify? See, again, to me, if you look at that chart without the fibs, it's just all over the shop. Particularly here. This is why I didn't, because it's not, this is a good example of a day not to sit in a trade for a long time. Because it's just too choppy. But if it sits on a, if the cleaner the chart, the cleaner the golden anchor, then the better, the higher the probability of the move. That's really, really important. The cleaner the golden anchor, the higher the probability and the bigger move you got. So that level there was major on Thursday. Let's go back to the Dow. Let's look at the DAX. Ooh, the DAX did a good move. I don't pay too much attention to the DAX because I find the DAX hard to trade because it hasn't got the volatility. I'm a momentum trader. I like volatility, and this just hasn't got the volatility that I like. So on Friday, this is really crucial. If you hold the previous day's high, that is really, really bullish. If you hold the previous day's high, that's really, really bullish. And of course, if you hold the previous day's low, that would have been very bearish. So on Friday, this DAX held up really, it didn't give you many points, but it was very bullish. There's the European Open. There's the London Open. And we held that London low all day. Sorry, we held the European, no we didn't. We did breach the London Open, but we held the European Open all day. This was the European Open here. That's the European Open. So we touched it, we tested it on the London Open, the London pullback, the US pullback, and closed, had a good little run into the close, but hesitated in the last hour. This is the futures market, obviously. So the European Open close was here. So we hesitated into the European close. But again, not a lot of 50 pips in it. These were 50 pip moves, 40, 50 pip moves. How am I defining volatility? I'm defining volatility by the intraday range and using volume. So this is one method, not the only method, but it's one method. Decent volume. Yeah, this is not good volatility, but it's got decent volume. And the range, it's a range that's important. So the reason why I like the fib so much on the previous day's range is because if you've had a volatile day the day before, then the fib is going to be cleaner. It stands to reason. If you've had a good volatile day before, see the DAX has been fairly flat, and this was not bad on Tuesday. So the bigger the move, the more volatility, the happier I am, with volume to confirm. So the bigger the prior day, the bigger the day before, the more chances you've got of a cleaner anchor chart and a better move. That's really important. So if the previous day has a lot of volume, a bigger range, then the next day is probably going to be cleaner, going to cling, hold on to these zones or extensions and give you bigger moves. Does that make sense? Well, let's take a high volume day like Tuesday. I think this 5,000 mark, I'm going to say 5,000 contracts on a 15-minute chart. We hit it on Wednesday, Thursday, and Friday. We didn't quite get there. Look at that. We got a choppy day on Friday, and we didn't hit the same volume high. We didn't hit that 5,000 mark. So good volume, good volume, good volume. We did okay, and we just tailed off into the US section, which is normal anyway. So Friday wasn't bad. Friday was okay for volume. This was slack. Slack on Monday. Decent on the 9th of January, and so on. Volume is the oxygen of the market, isn't it? So let's look at what's another good market? Let's look at gold. So yeah, so potential 127 extension sell up there at 1560 if for an intraday trade. Obviously, yeah, gold's not that volatile, is it? I used to trade beans a lot. They're just not volatile enough for me today. There's some good. No. Your last point. So to trade DAX, is volume the only condition? Absolutely not. No way. I'll put it the other way. If the volume is really poor, then I wouldn't trade it. But the main criteria of any trade for me is the golden anchor. The main criteria for any trade in any market is the golden anchor. So it's the fibs on the previous day's 24 hours on a 15-minute chart. That's the main criteria for whether I want to trade it or not. Because the previous ECB days, again, the main criteria for not trading the DAX, I didn't trade the Dow on Friday, and this goes for the DAX as well. I didn't trade the Dow on Friday because It's option expiry. So the third Friday every month is options expiry, and it's nearly always low volume and poor. By the time you get to options expiry, there's so many billions of dollars hanging on options expiry that the moves are nearly always over by the time you get to options expiry Friday. So it's always down to the golden anchor, always. And this was just a whole lot of slop. Not interested. It doesn't hit the 127 extension. It doesn't quite hit the zone. It closes above the previous day's high, below the previous day's high. This is absolute slop. Absolute chop. I must have the cleaner the golden anchor charts, in other words, the tighter the price sits on any one of these levels, the higher the probability of the trade. Why? Because Fibonacci is giving me support and resistance levels. So if I can see the market is picking up on those support and resistance levels, then and you've got volume to confirm that your trades are going to be higher. They should be higher probability. And that's why it's well worth spending a lot of extra time on these golden anchor charts to really get that. If you understand how the golden anchor works and the importance of sticking to these clear Fibonacci golden anchor levels, if you understand that with the volume confirmation, then you should be a good profitable trader. Okay, right. What I suggest we do, I suggest we take a break, come back at past and go straight into the simulated trading. Does that sound good to you? Good. Right, I'll see you in 7 or 8 minutes, and then we'll go straight into simulated trading. All right, see you then. See you at past. Right, so simulated trading. So this is the Dow. It's a while back because you can see the levels. The pink dotted line is the gap. The market's just opened. This is the 27th of March last year. I'm just about to mark off the range. I appear to be just marking off the open high. So let's get this market to open. Now what I want to do is get you to call the trade. So if you punch in, I'm going to stop the video and wind it on to important parts of the open session. I'd like you to tell me where you would take a trade, where your stop would be and what your target would be. So we'll look at the golden anchor as this video unfolds, and then we'll see where we are. Actually, this is 2:05, so I don't know why. Okay, well, let's just get this video started, and then you call the trades. Oh, I see. Okay, now this is the open, right? Okay, so at the moment we've got. Let me just stop the video there. So we've got the range. You can see that the market coming to the gap. So, like I said, you type into the box at any point in which you see a trade setting up. Can't get my chat box to work. Hang on. Oh, there it is. Okay, so let's just roll the video and let's just see where it's going to go. I'm just looking at support down there at 585. Right, okay, so there we are, just with the golden anchor chart. You can see on the golden anchor chart in the middle, so these are different colors. I've switched to white charts now, but you can see in the middle we've come off of the golden anchor has come off of a zone, or breached it and come and dropping back underneath it. You can see we are hitting the gap fill. We only just triggered short. So on this middle chart here, you can see how we're just already hitting the zone in there at 639. So although we filled the gap, we've actually gone through the gap to find the anchor level. So you actually got a signal bar here. Can you see the second bar was a signal bar? If I stop that. So the big green bar is the range. We've got a range of 677 to 756. That's a pretty big range. Yes, the open bar is that green bar. Can you list for me the critical factors that you see in the 5-minute chart and the golden anchor 15-minute chart? What are the critical factors that could have affected a decision to trade this? Can you just list them for me? I can see, I think you should have at least three things on your list. Okay, well, I'll go through them with you then. Yeah, that bar has not, it's not formed yet. Yes, yeah, yes, it must have been. Yeah, so the green bar. So we had a green bar to start the session. Yes. So we are nearly half an hour into the open. We're just about coming to half an hour in the open. So several things to know. A lot of selling on the previous day. So at the open, we've gone into the golden anchor zone and just breached it. So we've had, this is the open bar, and the second bar is a signal short into the golden anchor zone. Okay, so that 750 was a good reason to short based on the fact we had a gap down there and that zone resistance up there. So in fact, 756 was the high. That looks like about a 745 entry. So if you took that signal bar as the third bar crept back in there, you can get a pretty close. A 20 pip stop is plenty. It should be reasonable amount of space to short that from that high to at least get a gap fill. So you're risking that much, and your reward was that much, based on the second. So 10 to 15 minutes into the open, it did trigger scalper score short based on a signal bar. And you can see you could have used this 639 target as the low. So that's the gap fill and more. And bear in mind, we've got all this support down here anyway. So about 645 to 640, So it's 7.45, sorry, that's about 100 pip move. That's close to 100 pip short there, based on a signal bar. Not bad. Let's see how it unfolds. Now, does that all make sense? So golden anchor, 15-minute chart, fibs on the previous day's high and low. There's the outer zone, inner zone. So we just breached the outer zone and we pull back into the inner zone. So you could have traded that off of the golden anchor itself. If you were trading only the golden anchor on a sell day like that, that is a pullback into resistance. So that ticks a box, signal bar ticks a box, gap ticks a box. There's 3 boxes you can tick for the short. Let's see how it unfolds. What about the 50%? I would ignore the 50% because of the gap. So the 50% is 670. 670 is just under the range, but 646 is the gap fill. So based on the close proximity to the gap, I would go for the gap fill, and I think you're more than justifiable going in for a lower number based on these, based on the fact we've got 600 down there. That might go to 600 or lower. Let's see. Let's play the video out and let's see what happens. Hang on. Yes, I'm suggesting that it could come down to that 600 mark, judging by the way in which I'm. Okay, so I've gone back to the open range itself, zoning the support. Let's wind the video on a bit. Where are we? Oh, got loads of time on this. Okay, so I just watch this. Right, so I'm accelerating the video now. Yeah, so come right into that zone I've just marked. Yeah, it looks as if it's going to hold that gap. Now, if you get a buy signal on the signal bar on the 5-minute gap fill, with all that support underneath it, that could, I mean, look at all the green on the 1-hour chart here and all the green on the golden anchor. So the Europeans have pushed this up from about 550 to 750. So it's possible if we get a close back in that range of 677, I wouldn't mind betting that could go back up. Let's have a look. So we definitely, so that the first 100 pips is banked. We could have taken at least 75 out of that. Still closing lower. Whoops. Gone to a white, that's a bit odd. Why have I gone back to a white 5-minute chart? Never mind. So yeah, we're holding that gap. We appear to be holding that 20-day, the white average is the 20-day. We're sort of holding the 20. We backfilled to the golden anchor zone. And we look as if we're going to close above that gap. Let's have a look. This is, I think this is an hour and 10, no, sorry. This is 40 minutes into the period. So let's just stop it there. So would you, no, this is, there is a 2-week period in March and a 2-week period in September where we are 4 hours apart from the US instead of 5. This is on the 27th of March 2019. We were only 4 hours apart. This is the cash open. No, this is the cash open. Okay. What would you have taken a trade on this? Do you see a trade setting up now at all? So we've talked about 7,500 pips short. Would you do anything with this market, or would you leave it? Not sure. Okay, if you're not sure, then don't trade it. If you're not sure. What I'm suggesting that because we've had a couple of things suggest this might be a good pullback for a long, decent move from Europe and the open. So I've not got volume on here, but let's assume for the moment that there must have been a decent amount of volume to take that from close to 550 to 750. So this is a nice wave to the upside. If we're going to hold this gap and close back into 677, we've already got a higher close above the gap off of this 20-day average and the zone. I can't remember what happened on this day, but I wouldn't mind betting this could be a good place to buy. If the golden anchor closes above that 665, I think this might go back to the highs. Let's have a look. Let's play the video out. I'll speed it up. No, it's a potential fade at the moment. Right, we are looking like we're coming off. Yeah. So one way you could try, I'll stop the video there. If we close back in, if we hold the gap, or we've holding the gap, we now hold the 677 and close higher, I would buy 677 to see if we can come back and close above here and potentially get above 800. Right, let's play it out. Let's zoom it on. Right, so we've 677 is now a potential entry now for me. That is enough evidence there and a close above the 50% to suggest this could go higher. So I would look to buy a 670. Let's see if I'm right. It doesn't get back to, it only pulls back so far, just above that floor. There. So the gap, the actual best entry was 650. Right, let's go to the end of that. Just look at the end frame again. So the actual 650 off the gap was a good, and that's 50 pips. At the time this video finishes, you're 50 pips to the upside. That's what I was hinting at when I was looking at drawing that zone on the 5-minute chart. You know what? I actually think because of the price level on the 640 zone and the 646 gap, I personally would have been buying at the 640. I would have taken a golden anchor trade off 640 on that one. If you look at this 60-minute chart on the left, had 2 hours, had over a 3-hour period, we actually hit 740 at the high. Sorry, 750 plus, 760. So 640 from an already high of 750 is not bad. I think that's pretty good. So the hourly chart and the golden anchor, especially with that 20-day average sitting underneath it, you're trading the right side of the decent 20-day average there. 640 to me would be a good entry, and as this video has stopped, you would have been nearly 70 pips up at the point in which the video stops. A safer way to trade it, as you've pointed out, a safer way to trade it would have been to trade it off the 677 floor once you had confirmation of a close inside the range. It doesn't look as if it goes back to 677, judging by this video. In fact, if I go back to the 27th of March last year, yeah, from the 25th of March to the 5th of April, we made this move. So you're actually above, where are we? That's the 25th of March there. So you would so the pullback at that 640 was trend. It was a trend trade. 27th of March. Wednesday the 27th, we actually closed at 600. So we peaked on that day, we peaked at 770. Very next day we closed higher we closed at 800 the next day, and we went on a little run. So you were trend trading at 500 that day. So 640 was only 140 pips off of this setup. So that was a good little trade. So if you look at fractals, so we're focusing on the 5 and 15 minute. But the 15-minute chart on that day gave you a reason to buy. Okay. Are you okay with that? Any questions with that? For that video, so if you just traded off the golden anchor alone, you would have been buying a touch of that 20-day average or the 639 on the golden anchor. Elliott wave. I'll keep introducing Elliott wave because I do think it's important. 1, 2, 3. I'm pretty sure we went to 800 on that during the day, but closed on. We actually closed around about the 50% mark that day. We actually closed on the 50%. We went possibly a little higher, but then finished on the 50%. So not a big volume day, but the very next day we closed above 800 and climbed up here over the rest of that week. I think we ended up close to here by a couple of days after this was videoed. Remember I said to you I like to fib the previous week. Well, on this particular week, we had a low of 25.5. The week before was 25.5 versus 26,100. Okay. So we were closing above this zone on the 60-minute chart, hitting that zone, but ultimately came up to hit 50% at least on the 60-minute chart. I think we breached these. I think we came up to the 980. I think so. We went from a 127 minus 127 to a zone high during that week. Yeah, you got a question on the Elliott? Yeah. Elliott's not crucial. It's not crucial that you follow Elliott. I think it's very, very healthy that you look into it and study it. At least give it some of your time. But I think it's a useful extra tool in your toolbox. How do you define it's a second wave? Right, good question. That's a big move. That's a wave one in anybody's book. So into the cash open, so 45 minutes into the cash open is the end of wave two. Now wave two is normally 60% of wave one. It's normally a PB, a pullback, is normally 60% of wave one. So if wave one is about 550 to 760, that's a healthy pullback. You can get you can definitely get shallower pullbacks. It can be as little as 50%. If it's incredibly bullish, we could have seen that level hold, but ordinarily I'd expect it to drop 60% of the wave one, and that low there with the gap fill did fulfill that criteria. This 60% is a standard. It's a standard Elliott wave definition to me. From all the research, I've read the book. Yeah. Anyway, that aside, if you just ignore that and just look at the gap, let's just study the gap from it. That's 646. Even forget the range and forget the golden anchor for a moment. If you've had a really bullish move like that and it holds the gap, that's a decent, you've got a lot of support propping up that price for a potential move. So gaps are really important. Let's come away from that video a second. Just talk about gaps for a moment. Let's go to a 60-minute chart. So I call up I prefer these bar charts. Let's just, because I want to be very clear on this. Right, this is the Dow chart from the week just gone by. So there's the previous week's move. So we had a low of 28,122, a high of 29,057, and there was the Friday electronic close. Was it 9:30 our time, 10 o'clock in the evening? That dotted line, 8:03, was the Friday electronic close, futures close. So on Tuesday, I think it must have been Tuesday, we just breach it. This pink bar here is the Friday low and the Sunday Asian Open. Well, the Friday low is a bit lower. But it's the last couple of hours of trading, and it's the last hour of trading, and the gap up. We gapped up on Sunday. So this range was really, really important. So on Monday, they came and found it, pushed up. Tuesday, they came and found it and breached it and immediately closed higher. So that was a very, very bullish day on Tuesday. There was evidence on Tuesday that this market could come back to find the high and potentially go to the 161 extension, 127 extension. So on Wednesday, that's what we did. We found the 127 extension up here at 29,310. And then on Friday, we just breached it and came back and tested it. So Monday was key. Tuesday close and price action above this area was key. Wednesday, we had a structural breakup. Thursday, we launched into the 127 extension. Friday, we just rested. On Wednesday the 8th, on the Iranian missile attack day, we breached this three-wave pullback. Ordinarily, I would have expected 244 to hold. We went to 122. And then during Wednesday morning and into the Wednesday close, we completely engulfed the Monday and Tuesday price action. So the 60-minute chart is a good way of plotting the week. So now, next week, this is what I'm going to do now. I'm going to clear all this up. Push this, we don't need this. Push this into that 306 or 307 close. And now fib the week. The only thing I'm going to add to that is the Asian Open. Right. So if this market is really bullish, I would expect a drop to at least 250, 258 at least. If we become bearish, I would at least start to see a break down through 258 and a close under 258. So that 258, that 250, 258 is going to be really crucial. Because if we start to close underneath that, then this market could be in trouble. Okay, what I suggest is we leave it there, and I'll send you the link to the, I've already put you in the Telegram rooms. There's 2 Telegram rooms. Let me just show you. This Telegram room is the main one which is reserved for just me to post suggestions and trade ideas and what I'm trading. This room here is for members like you to talk about what you're seeing. Okay? So one for me only, one for you members to talk in. I'll send you the link to the room. I might as well do that now. Hang on a second. You need to register here. You don't have to join the Telegram room. You're in it, but if you, that's where the alerts are. That's all. That's where the suggested trades are. That's where I talk about what I'm trading. That's all. That's, you can't see it on the mobile. There is an Android and an Apple app for it. Have you tried downloading it? Right. Well, you should be able to log into that and see it. I'll tell you what. Let me. If I post something in the room. That should come up if your app is properly logged in. You should see that message on your app now. Can you see it? Okay. Well, drop me a line if you have any problems. Click on that Zoom link and register. And when you get an email from Zoom, you must keep that, because that's going to be the room link for the foreseeable future. You see two, right? Okay, good. Well, that must mean that you can. So your mobile app should be working now. Then you can get it on your desktop or your mobile, your smartphone. You can see it on both. I use it on both. Yes, that's it. Right, don't forget to click on that Zoom link. So the first live session is open 2:25 next Tuesday. The US is off on Monday. I'm sure the US is back on. Let's have a look. Let me just double check. Yeah, the US has to be back on Tuesday. It's just Monday they're not around. Keep an eye on any data that's coming up. I use a couple of things. You may already have this, but I use Forex Factory. I also like this one, tradingeconomics.com. I find Trading Economics better, actually. So just to recap, if the gap is less on the Dow, if the gap is less than 70 pips, then you get at least you normally get 50% gap fill, if not 100% gap fill. If it's more than 100 pips, yes, the alert and the chat room is working 5 days a week. And also the weekend video goes out on those on the Telegram rooms as well. So keep an eye out for the weekend video tomorrow on that app. So the golden anchor is absolutely, the golden anchor is key to what we're doing here. Volume is confirming. If we're not sticking to golden anchor levels, then it could be choppy. And if the volume is too low, again, it could be choppy. If you lock into that and the 3 types of entries into the open trading range, the trigger, then the midpoint is 1, the signal bar on the floor or the ceiling is 2, and the aggressive entry with a very excessive big volume 6,000 contract plus on the Dow is a potential aggressive entry. Right, if you tie all that together, then you should be a profitable trader. Any questions before I close up? Any questions at all? (2:20 p.m. UK time on Tuesday, Wednesday, Thursday, Friday. Otherwise, look out for suggestions on the Telegram from 9 or 10 o'clock, and then 6 to 8 o'clock in the evening for the Dow. Oh, the close. I just do the previous 24 hours. I always do the 24 hours. So, so this was Thursday. UK 24 hours. Pick up the high. Pick up the Asian low. And the cash market's right in the middle. The cash market is in the middle of that. Okay. All right, well, let's leave it there. Enjoy the rest of your weekend. I will send out, I'm going to send out the video tomorrow, if that's okay, because I just want to do a couple of adjustments to the check sheet. And so you'll get that towards the end of the weekend, and then make sure you register for that Zoom room, and then I'll talk to you, well, see you in the room on Tuesday. Thanks very much, and see you then. Bye. Have fun.